7.8%. That's the eye-popping annual interest rate on offer for 12-month deposits at some major banks right now, as of July 26th. This isn't your local savings account generating pennies. It's a screaming market signal for any entrepreneur or side hustler serious about capital strategy. Think about it. While global markets flash sell signals and volatility reigns, pockets of the world are offering incredibly stable, high-yield opportunities for your cash. This specific data point is a crucial read for anyone trying to navigate economic shifts and find genuine alpha in their financial planning. It's an indication of where capital is being valued and what that means for your money right now today. On July 26th, a detailed survey of online deposit rates across Vietnam revealed a fascinating landscape. 7 banks were offering 7% or more for 12-month terms, with ACB leading the pack at a staggering 7.8% annually. Other significant players like Saigon Bank and Bac Bank are close behind, hovering robustly around the 7.2% mark for similar terms, even extending those attractive rates to 6- and 9-month deposits. This isn't just about high yield in a distant market. It's a powerful indicator of capital demand, inflationary pressures, and the true cost of money in a rapidly developing economy. These dynamics create ripple effects for international business, especially for those involved in global supply chains or looking for stable financial anchors. What's truly wild about this is the significant rate differentiation across the board, especially for terms over 6 months, revealing banks are aggressively competing for every dollar of capital they can attract. The hard data from that July 26th survey reveals a stark divergence in rates, particularly for longer-term deposits, which is where the real game is played. While ACB dominates the high end with 7.8% for 12 months and 7.6% for 6 months, even the traditionally more conservative state-backed giants like Agribank, BIDV, Vietcombank, and Vietinbank are maintaining a solid 6.8% for both 12 and 18-month terms. This broad spectrum, with 7 banks firmly above the 7% threshold, signifies a robust appetite for deposits, likely fueled by strong domestic lending demand or proactive measures against inflation. For anyone running an e-commerce operation reliant on global supply chains or considering manufacturing expansion in the region, these rates impact everything from the cost of local financing and raw materials to the stability of the local currency against the dollar, directly affecting your profit margins. It's a clear signal on the cost of doing business and the value of holding capital in this specific economic environment. Here's what nobody mentions about these high interest rates in specific global markets. They represent a tangible, often overlooked opportunity to diversify your capital holdings and explore alternative, truly passive revenue streams far beyond your traditional investment vehicles. While your local bank offers fractions of a percent that barely beat inflation, savvy entrepreneurs are quietly exploring options to move a portion of their reserves to secure these higher yields internationally, effectively creating a significant passive income stream on their otherwise stagnant cash. This isn't just about saving, it's about smart capital allocation in a globally connected economy. For an actionable step today, research global banking options that explicitly allow non-resident accounts or explore fintech platforms specifically designed to facilitate cross-border high-yield savings and currency management. Tools like Wise or Revolut are crucial starting points for understanding how global entrepreneurs manage international funds efficiently. Don't just watch the market signals from afar. Understand them, and then act on them to grow your wealth. Hit that subscribe button for more actionable insights into how real entrepreneurs are building financial freedom. Savvy financial analysts aren't just seeing high yields. They're dissecting the underlying market dynamics that create them. What many economists observe is a strong domestic demand for capital, or a strategic move to attract foreign investment. For us, this translates into a compelling signal. Where capital is valued highly, there are often robust opportunities to deploy it, or to simply secure significant passive income from holding cash. Think about it. A 7.8% return on cash isn't just a number. It's a benchmark that shapes investment decisions, forcing businesses to achieve even higher returns to justify operational risk. This environment demands a sharp focus on capital efficiency, driving innovation in areas like fintech and specialized lending. Globally, such attractive interest rates in one region inevitably create a magnetic pull for capital. Wealth managers and institutional investors are constantly scanning for yield in a world often starved for it. A 7.8% return for a 12-month deposit, as seen at ACB and other banks on July 26th, makes a compelling case for fund reallocation. This could indirectly shift investment away from lower-yielding developed markets or even other emerging economies, creating a subtle but powerful ripple effect. Businesses that facilitate these cross-border capital flows, perhaps through secure digital platforms or specialized wealth advisory services, stand to gain tremendously from this reallocation trend. Look back at past periods when specific regional markets offered superior yields. The playbook for smart money becomes clear. Think about the late 80s or early 90s in certain Asian tigers or even specific European markets. Those who understood the mechanics then moved their liquid assets to capture that yield, effectively turning their cash into a high-performing asset class. What followed was often a boom in services supporting wealth migration and secure asset management. This isn't just about saving, it's about making your reserves work harder than ever. A strategy that has repeatedly paid off for those who spot and act on these rate differentials. Clear winners are individuals and businesses with readily available cash looking for safe, high returns. We're talking about freelancers, small business owners with healthy reserves, or even Shopify store owners who've accumulated significant profits. They can park their operating capital and earn nearly 8% annually, effectively subsidizing their overheads. Unexpected winners? Businesses offering advisory services on international asset allocation or digital platforms that simplify access to these high-yield accounts for foreign investors. The main losers are local businesses heavily reliant on borrowing cheap credit, as the cost of capital within that market naturally trends higher to compete with deposit rates.